My name is Nick Hecker. I work for a company called Sculptor Real Estate. We're a New York-based real estate private equity fund. We invest in opportunistic equity and opportunistic credit in both North America and in Europe. I've been there for about 15 years now. We're just starting to invest our fourth opportunistic equity fund. It'll have total capital commitments of around $2.5 billion. We have spent time in the past years investing in the Caribbean because a lot of what we do is focused on non-traditional asset classes. So while we invest in things like office and apartments and industrial, we spend more time investing in less traditional asset classes, be it all-inclusive resort, golf, marinas, gaming, cell towers. And so the Caribbean falls into that segment of our strategy.
Kick this one off with Nick talking about capital markets, and just tell us a little bit about what's the state of the market, what's going on, what are you guys busy doing?
Perfect. Sure. One, there's a really interesting dynamic here, just thinking about this relative to the global financial crisis, where there's so much more capital still in the markets than there was back in '08. And so, after an initial shock, as soon as the Fed stepped in and basically told the market that they would essentially do whatever it took to guarantee stability in the capital markets and soundness of the banking system, you have seen this influx of capital back into the public markets. But what really stands out to us is how bifurcated it's been. And not to be overly simplistic, but I do think you can kind of divide it up by size, where large public issuers, and public meaning either US public companies or private companies that might have public or traded debt, have had a much, much easier time attracting capital than everybody else. And you've seen even the most troubled asset classes, something like department stores. Big chains have been able to go out and tap the capital markets. And that doesn't really exist for owners of single assets of hotels or resorts or really anything else for that matter. And so if you think about how that impacts the Caribbean, there is this real bifurcation between owners of large portfolios who have access to US institutional capital markets, and the owners of the one-off single assets or smaller portfolios that either have a local banking relationship or a small syndicate. And I think it's important to distinguish between getting some relief or getting temporary forbearance versus actually being able to raise new capital. Pretty much everyone across the board has gotten whatever degree of forbearance that they've needed for some interim period. The big question is going to be in a few months when that wears off and when there's a need for new dollars to cover operating costs, hopefully fund startup expenses at some point in time, what markets are available to tap. And again, I think this bifurcation between the larger, more institutional companies that have tapped the US public market in the past are going to have a much, much easier time of it than those that have sort of local banking relationships. And that latter category is a big, big component of the resorts in the Caribbean. So I think that's something we're very focused on. In terms of what we're spending time on in the investment opportunity set going forward, I think, firstly, as a lot of people have observed, it's not like there is a huge amount of private deal flow just yet. And so we do think generally this is going to be a more medium to long-term opportunity set. This isn't just a few months. More broadly, in terms of what we're looking for in deals in the Caribbean right now, or how we start thinking about investing in this environment, typically when we're investing in a hotel or any other asset, we do a lot of diligence, we build a complicated model, but at the end of the day, the most important thing that we focus on is really one page in our investment committee memo. It's our page of highlights and risks, and we weigh those, and we think about the returns that we're generating relative to those risks, and do we think it's an attractive overall package. And a key question for us when we're thinking about that dynamic, are the risks in a deal something that we actually can underwrite, that we have some sort of expertise or qualification to be able to underwrite. And when you think about the risks in a typical real estate deal, maybe it's construction risk, risk of new supply, cap rates increasing over time, labor costs, those are all typical. And those are the kinds of things that we can look back over many years and many cycles to be able to make informed decisions when we're projecting out future cash flows. They may not be the right decisions, but they're based in some set of data and some set of objective criteria that we can look to. I think when we look at that set of highlights and risks today, it's a much different animal in the Caribbean especially. And so that influences how we think about the opportunity set, and as importantly, what the return targets should be for our capital. The highlights are actually pretty compelling now. You have significant pent-up demand. As I mentioned, general consensus is that leisure will recover before business travel. There is still supply to come online that's currently under construction, but after that, supply sort of cycles through. It's very hard to see a lot more new supply coming online anytime soon. And again, the Fed has gone out and said interest rates will be zero sort of indefinitely. But when you then shift and look at the risks, there are a lot of things that I put in the category of very difficult to underwrite, and things that you question, are we really qualified? Are these the kinds of things that our limited partners expect us to be underwriting? And something like timing of a vaccine, is not something I have any experience underwriting. When and how does airlift return? There are so many potential variables around that. How will consumer spending be impacted by everything that's going on over, again, the medium and the long term? Very atypical risks for real estate investors. And so with that backdrop, how do we think about investing? What do you actually do? I think the punchline is to underwrite very conservatively. Assume the worst in terms of recovery timing. And so should there be a full recovery in a year or two, that's obviously great, but I don't think that should be the right base case for somebody investing in underwriting an opportunity in the Caribbean right now. We want to be in a position where if things take 5 years or longer, we may not make a great return, but we're not going to lose capital. I think related to that, we're very focused on basis right now. And one of the things that we focused on historically in the Caribbean is investing at very, very deep discounts to replacement cost. So we're always at a basis where, while we may not predict the year right or sort of little movements, if we look back over many years and many cycles, we feel comfortable that we own an asset at a basis that is supportable based on where things have traded over long periods of time. We also don't want to be taking any more risk beyond what's already in the market on something like airlift. And so, on the one hand, a San Juan, a Cancun, airlift will always be there in some form or fashion. The islands where there's been one subsidized flight a day, we worry a lot about. And I put that in the category of risks that there might be no return that you would want to get paid for that kind of risk in this environment. Similar with just general jurisdictional stability, something we always focus on, but I think even more so now. Staying in the countries, the islands that have a really proven track record of stability, rule of law, I think is as critical as it has ever been. So when you look at all those factors, then you focus on, well, what should returns be? And clearly, when we think about it, they should be higher than they were. For all of those types of risks, you shouldn't be doing it to earn an 8 or something like that. Now, going the other way, even to the extent there was always less leverage in the Caribbean, there's that much less leverage today. And so that's a little bit of an offsetting factor because we focus on risk-adjusted returns. And so if we're making unlevered investments, obviously the return target can be lower, but in general, it should be elevated for all the inherent risk that's in the market right now. So I think just in conclusion, we are certainly looking at investments in the region. We're excited about opportunities in the region. We think it's very early. We will stay focused on major markets with historically strong airlift, stable governments, and really we'll focus on generating attractive unlevered returns at very deep discounts to replacement costs. I don't know if you call it a silver lining, but for better or for worse, there's no other region that has as much experience getting shut down and then reopening as the Caribbean, and whether it's hurricane, virus, sargassum, whatever else. So just from an operational standpoint, there is a history of looking at the time between when an event like that happens, how long till full recovery, and then operationally, I think operators in the Caribbean have gotten better than pretty much anyone else in the world at going through these things and reopening, restaffing, figuring out how to manage dollars. So it's trying to hit a moving target a little, but I actually think this region is somewhat uniquely positioned from just a strictly operational standpoint to go through the shutdown, reopening, how to ramp back up, how to train and hire and deal with airlift slowly coming back. But it's very much trying to hit a moving target.
Do you guys see development, completely being put on hold, or are there going to be some niche developments coming on in the near future?
Where there will always be a handful of high net worth people that can build all cash. But I think supply will go down a lot. And I don't think that's a terrible thing, because if you look over the past couple of years in places certainly like the Yucatan and Punta Cana, one of the things that was impacting those markets was oversupply. Well, thank you for having me. And I do just want to say that I think ULI has been really exceptional during all this. And so I really appreciate all the programming. It's a time like this that you appreciate being a part of this kind of organization.